In the 1980s, South Korea faced high inflation rates that threatened its economic stability and growth prospects. In response, the South Korean government approach to managing inflation through monetary tightening, price and wage control, currency stabilization, productivity improvements, and export-led growth has proven adaptable. Countries today can learn from these policies, though specific strategies may need modification depending on the nation's economic structure, fiscal resources, and integration into the global economy. 1. Monetary tightening and fiscal discipline. South Korea's approach. In the 1980s, the Bank of Korea raised interest rates significantly to cool down an overheated economy. By tightening the money supply, the government reduced the amount of money circulating in the economy, which helped control demand-pull inflation. Modern example. In the early 2020s, the U.S. Federal Reserve implemented a similar strategy by rapidly raising interest rates to combat inflation after the COVID-19 pandemic. The Fed increased interest rates multiple times to reduce consumer spending and borrowing, which helped curb inflation but also slowed economic growth. South Korea itself raised rates to control inflation in 2022, following global trends. Lesson for today. Monetary policy remains a powerful tool against inflation. However, each economy's capacity to absorb high rates differs. Developing countries may struggle with higher rates if they lack the strong institutional backing seen in developed countries. 2. Wage and price controls. South Korea's approach. During the 1980s, the South Korean government intervened to limit wage increases, particularly in public sector jobs. It also introduced price controls on essential goods like rice, fuel, and transportation. This helped prevent a price-wage spiral, where rising wages push up prices, leading to further wage demands. Modern example. In the 1970s, during a period of high inflation, the U.S. briefly imposed wage and price controls, though the approach faced challenges in the long term due to inefficiencies and was eventually abandoned. However, a more modern and collaborative approach is found in Japan's recent efforts to contain inflation. The government encouraged companies to restrain price increases voluntarily and maintain wages at moderate levels. Lesson for today. Today, wage and price controls are often controversial, but in some economies, collaboration between the government, unions, and businesses can help moderate inflation. This approach is more suited to economies with strong social agreements between workers and firms, like Japan or certain European countries. 3. Currency stabilization and exchange rate policies. South Korea's approach. To control imported inflation, the South Korean government and the Bank of Korea took steps to prevent significant fluctuations in the won. By maintaining a stable exchange rate, South Korea managed to keep the costs of imports like oil, a major inflation driver, relatively steady. Modern example. In 2022, Turkey faced severe inflation partially due to a collapsing currency. The Turkish government attempted currency-protected savings plans to stabilize the lira by compensating savers for losses due to depreciation. While this policy wasn't completely effective, other nations like India have used currency interventions alongside foreign reserves to stabilize their currency more successfully in recent years. Lesson for today. Nations that heavily rely on imports, especially of critical goods like fuel and food, could implement currency stabilization measures if they have sufficient foreign reserves. These actions, however, should be carefully managed to avoid running down reserves or distorting the currency market. 4. Structural reforms for increased productivity. South Korea's approach. During the 1980s, South Korea invested in infrastructure, vocational training, and technology in industries like electronics, steel, and automotive. By enhancing productivity in these key sectors, South Korea was able to lower production costs and maintain stable prices. Modern example. China's economic rise was significantly fueled by productivity enhancements from the 1990s onwards. The Chinese government invested heavily in infrastructure and incentivized manufacturing sectors to boost productivity. More recently, India has implemented the Make in India initiative, aiming to enhance productivity in sectors like manufacturing and technology to control costs and boost exports. Lesson for today. Productivity-enhancing reforms can be a long-term strategy against inflation. For nations facing supply-driven inflation, investments in technology, infrastructure, and worker training can help reduce bottlenecks, lowering the costs of production and improving efficiency across the economy. 5. Open trade policies and export-led growth. South Korea's approach. South Korea pursued an export-driven growth strategy, focusing on sectors like electronics, automotive, and shipbuilding. This helped South Korea offset inflationary pressures domestically by leveraging global demand and benefiting from economies of scale. By scaling up production and keeping costs low, South Korea could price its exports competitively while reducing reliance on domestic consumption. Modern example: Vietnam has followed a similar export-led model in recent years, emphasizing electronics and garment production. The country's trade agreements and strategic location have made it a key export hub, which has helped keep domestic inflation lower as the economy grew through foreign demand. Lesson for today: export-led growth can be a powerful tool for nations with competitive advantages in certain sectors. This strategy could work well in countries with a strong industrial base or those willing to build one. However, the approach requires stable trade relationships and the ability to produce goods at a scale that competes in the global market. If you like this video, please encourage our team by clicking like button and subscribe our channel. This will motivate us to make more such videos.